Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, August 19th, 2020. We actually saw outflows out of the conventional fund business. We'll report more about the ETF pieces, but kind of highlight what happened to the fund industry right off the bat. Basically, we saw about $7.2 billion exit the coffer of the conventional fund business, second week in a row that we've actually seen net outflows. Just as it was over the last couple of weeks, we saw money leave equity funds and money market funds, but we saw tax-exempt and taxable bond funds actually taking money. The indices were mixed this week. We saw the NASDAQ actually post a pretty nice return, 1.21%, while the Dow Jones Industrial Average was down about 1.01%. Basically, people are concerned about the COVID-19 issues that are out there. Although we have a declining rate in infection rates, we are seeing kids go back to school and schools closing down, and so there's been some concern there. But the other pieces that people have been looking at is the Sino-American controversies that are going on. But President Trump said he's ready to walk away from the agreement that they made earlier. Basically, the Chinese are coming back and saying that they are willing to, if they add extra tariffs, they being the United States, that they're willing to actually add extra tariffs. It's kind of a tit-for-tat type of situation. So again, people are worried about the American-Sino relationships and the tensions that are going on. And so I think that kind of put a damper on returns this week. Let's see how this kind of played out, though. If we take a look at our macro groups, we'll get a little better understanding what went on there. Equity funds actually lost about $5.1 billion, as I told you. We saw outflows out of that. Taxable bond funds took in $7.5 billion, kind of a nice run there. Muni bond funds, a handsome $1.7 billion of net inflows. And money market funds saw about $11.4 billion in outflows. And that's where the kind of changes pace have been over the last several weeks, is people aren't just in that flight to safety mode completely, just taking all the money off the table and, let's say stuffing it on their mattress, or in this case putting it in money market funds. We are seeing selective investments, and so people are putting money back to work, and it's been kind of with fits and starts. So we're not seeing it on the equity side, but we certainly are seeing it on the taxable bond and the tax-exempt side of the business, so the muni bond fund side of the business. Let's go ahead and take a look now at the equity funds and see how that panned out. Basically, equity funds lost about $5.1 billion. That flew out of their coffers. It is the 8th consecutive week that we've seen the returns in a positive territory, but this time only to the tune of about 0.01%. And it was the 7th consecutive week we've seen net outflows, 17 consecutive weeks. So if we kind of dive a little bit deeper into this, we see that domestic equity funds actually lost about $5.9 billion. It's the 10th consecutive week they've seen outflows, and they had a return of minus 0.01%. So really nothing to really talk about. But again, that trend has been that people are pulling money out of domestic equity funds, out of equity funds as a whole, but out of domestic equity funds. And what we saw then is that non-domestic equity funds actually, for the first week in 20, took in money, about $866 million this week, and they had a return of a 0.04% return, so on the plus side. It's the 8th consecutive week that they've actually seen plus side returns. So that's kind of where the story was. But if we break this down a little bit further, and we take a look at kind of the winners and losers of the group, we see that the large cap funds lost about $4.4 billion, and small cap funds lost about $899 million. So we had, again, $4.4 billion and $899 million for large and small cap. Now on the international equity side, we actually saw a flip there. We actually saw that international equity funds took in about $1.3 billion, and global equity funds lose about $387 million. Not a lot to write about, but again, investors seem to be willing to kind of tip their toes back into the water of international equities, even though they are, if you will, shunning domestic equity funds still. Let's go ahead now and take a look at the equity ETF side of the arena and see how that panned out. We saw for the second week in 3 that they lost money, this time to the tune of $1.5 billion. At the top of the group taking in money, though, was iShares Core MSCI EFA Index, took in about $1.6 billion, and then the Utility Select Sector SPDR ETF took about $380 million. Where we saw the iShares SPDR S&P SP, I was just going to say the SPDR SPY, but as the iShares SPDR 500 ETF SPY lose about $2.4 billion, and then we saw the Russell 1000 Growth ETF lose about $676 million. So kind of a trend pattern there. We're seeing both on the retail side and by the authorized participants, equity ETFs actually lost money as well, or I shouldn't say lost, but handed back money. They didn't necessarily lose it. There was net redemptions in that area. So that is kind of one of the areas that we've been focusing on, is the dichotomies between retail investors and institutional investors. And again, we seem to be somewhat in line with opinions in that case, where, again, we did see some money go into utility funds, and we did see some money go into the EFA, the European Asia Far East type of funds. But again, we're seeing domestic equity funds take it on the chin, both on the retail and institutional side. Well, let's go ahead now and see what happened to the flows for the fixed income universe and get a play-by-play there as well. For the 19th consecutive week, we've seen net inflows, about $7.5 billion this week. And it's the first week in 8, however, that we saw negative returns, this time to the tune of minus 0.24%. The main recipients of investors' money was corporate investment-grade debt funds, took in about $6 billion, while corporate high-yield funds took in about $882 million. Now, the big loser, and it wasn't big at all, were balanced funds. They lost about $146 million. And again, that's not too much to write home about. But again, so investors are still preferring, even though we've had kind of up markets, certainly we had the NASDAQ hit its 35th, not consecutive, but 35th record high during the month, and actually during the fund flows week as well. So that set a record. S&P 500 actually set a record this week as well. So I won't say it's a head scratcher. I think investors have actually chosen to kind of get out of some of the equity arena. It's been a long run that we've had, a long bull market we've had, and be content sitting on the sidelines, and not necessarily sitting on the sidelines, but putting money to work in taxable fixed income funds. Well, let's go ahead and see kind of what happened then to the taxable fixed income funds on the ETF side. Basically, we saw that they lost about $1.6 billion. It's the first week in 21 that they've actually seen net outflows. The top of the list as far as taking in money was the iShares TIPS Bond ETF, took in about $340 million. Then the X-Trackers US Dollar High Yield Corporate Bond ETF took in about $230 million. If we look at the bottom side of this graph, we see the iShares iBox Dollar High Yield Corporate Bond ETF lose about $1.2 billion. And we saw the iShares iBox Dollar Investment Grade Corporate Bond ETF hand back about $802 million. So kind of the same story there. We are seeing, again, net inflows generally in this arena. We saw it on the fixed income side, on the conventional fund business, but we are seeing kind of a backtrack on ETFs as far as handing back money in that area. Well, let's go ahead and turn our attention now to the muni bond fund industry and see what happened in the muni bond fund classifications. Basically, muni bond funds took in money for about $1.7 billion for the 15th consecutive week. It's the first week in 16, however, we've seen negative performance, this time to the tune of 0.32% loss for the weekly return. So not a lot, but again, maybe a little change of pace. So we've obviously seen a little change in the yield curve. The big winners actually taking in money were short intermediate term municipal debt funds, taking about $871 million, and the general insured muni debt funds taking about $691 million. And not on the graph, and I don't necessarily create a table usually for this. It's a very small universe, but ETFs in the municipal bond fund space took in about $88 million. It's the 16th consecutive week they've taken in net new money for this group. So that's a little bit of a story to talk about, is that, munis have not been gaining a lot of traction on the ETF side of the arena. At least not initially, but over this year, over the beginning of 2020, all the way through now, we've seen some fairly good flows in the muni bond funds after people decided that munis were okay to be back in, and the Fed was willing to, if you will, pull out all stops to make sure that there's liquidity in the market. People started embracing munis again, and particularly on the ETF side as well. Again, not the magnitude. Still, a conventional fund business attracts much more money on the muni bond fund side, but we are seeing a change of pace for muni ETFs as well. Well, that brings us to our last group, and that's money market funds. And as I told you a little bit earlier, the money market funds did lose money. It's the fourth consecutive week they've seen net outflows, this time to the tune of $11.4 billion. How it broke out, though, is taxable money market funds handed back about $11.7 billion. And if we break that down even further, we see institutional funds, institutional money market funds, handed back about $14.5 billion, while on the retail side, we saw that the retail money market funds actually took in about $2.8 billion. And if we took a look at the tax-exempt money market funds, they took in about $254 million, as people are maybe, trying to see if the market's a little dear or a little rich, On the muni bond fund side, again, we saw a little bit of a loss in performance, minus 0.32%, as I told you a little bit earlier. And so people might be kind of sitting on the sidelines to see what the yield curve is going to do and how it's going to impact money market funds and if there's inflation around the corner or not. Well, that does it for me today. Basically, as we take a look, at the market and what's going on, basically we've seen, some very strong up days, actually, in the hundreds. New records being set by the NASDAQ again. But I think people are focused on economic news now that we're almost done. We did hear during the week that Walmart and Home Depot actually came in with some pretty good numbers. Those builders, building supplies, and those groups that seem to be doing better during the close down of the economy seem to do very well. So they had some surprise numbers. But I think people are looking at the existing home sales, which came out today. It's up 24.7% in July, so that was quite a story. But we're also hearing some news that the COVID-19 number of new cases is on a slight decline, and I think people will be keeping an eye on that. And of course, the biggest thing I think people are keeping an eye on is the stalemate on Capitol Hill, concerning basically a new round of unemployment relief for those people still impacted. Our unemployment rate is still at 10.2%, and a lot of people are suffering because of lack of money to pay off, whether rent and food and the like. So I think we'll keep a keen eye on that as well. Well, that's it for me. If I didn't do a deep enough dive, though, for you, you can go to our site at Lipper. Actually, I should start out with the www part at www.lipperusfundflows.com. Or you can join us next week where one of our analysts will talk about the flows trends for that week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.